Welcome to the Daily Update, where I'll go through the action in the market for Monday, May 22nd, and then we'll see how things look for Tuesday, May 23rd. We had kind of an update today. It was pretty much unchanged. The S&P is really having a difficult time of closing above 4,200. We can go above 4,200, dance around there for a little while, but then we end up coming back down. Now, one scenario to think about. The NASDAQ and the NASDAQ 100, especially the NASDAQ 100, has been doing quite well lately, and it's starting to get to the point where it's looking exhausted. I have a few charts to show you there. If that happens and starts to turn back down, and the S&P's at around this 4,200 level, also bumping into resistance, are we going to see some kind of a shift at that point? I'm not saying that's what will happen. It's just when you look at the charts, that's kind of what comes out right now. Because of these negative divergences that we're seeing, because of the overhead resistance, because we're just seeing a few stocks really taking the market higher. When those things all come together, now I'm not saying that it's going to be a major downtrend. It could develop into one. All we're looking for right now is just some kind of a pullback. Then we'll take it at that point day by day going forward, and then try to evaluate, are we shifting more negative or are we just pulling back before we're going to get set to try to really take things higher? There's some really positive things right now, and there are some negative things right now, and you'll see that every day. The market likes to climb a wall of worry. When everything lines up either positive or negative, that's when it's pretty much over with, and then we are looking for a real shift. Just some things to take care of before I get going. I do have a supplemental video. It's about 2 weeks old now. The charts are starting to change a little bit, and I have a few to update here in this video, but please feel free to go back and check that out, see what you think, see if it helps you get any additional insight as to what's going on. I do have a PDF of all the slides and charts that is always available in the description. I do have a private Facebook group, and I'm trying to post more things there all the time. I do have a poll that's posted this week. It's on the community tab on my YouTube channel. I also post videos on Rumble. Here is the link. Last week I ran into a problem where YouTube decided to just wipe my channel out for a few hours. I didn't know how long that was going to take. If you ever come to YouTube, I'm not there. You can't find my videos. You like to watch the videos. Please shift over to Rumble, go to this channel, and unless they both take me down at the same time, there should be a video there. Let's go back and talk about what happened. We did have a positive open, and prices almost got up to R1 at 42.10 before we fell down below the daily pivot at 41.95 and the unchanged level. We went negative for a while. As the day went on, though, prices rose back up to the daily pivot and then just chopped sideways. They tried to take things higher later in the day. That wasn't really working out. And then late day selling took prices back down to just above the unchanged level. It was virtually unchanged on the day. We were up 0.02% on below average volume. That seems to be the real story these days. Our technicals were positive still in the short term. The longer we spend under 4,200 before we try to go higher, the less likely it's looking more positive. Now, there are some things that could develop if we have a good solid up day. But if we have a down day, that is probably going to shift back more negative. Intermediate and long term, we're still hanging in there for the most part because of this inflation and interest rate scenario. But the big thing that's really on the mind of the markets is this debt ceiling issue. We're coming up to that deadline. There's information coming out that they're talking, they're not talking, they agree, they don't agree. They're both digging in their heels. It's usual political posturing, but unfortunately, it kind of holds the market as a hostage. What are some comments that we can make? There's a lot of uncertainty still about the debt ceiling and what's going to happen with all that. They're probably going to work out a deal because this is all political in nature. They're going to threaten with this, and you're going to have to shut down that, and all these things are going to go flying back and forth. But when push comes to shove, it is likely that they will reach some kind of a deal. If they don't, then we'll just deal with it at that point. Over the weekend, Janet Yellen, with her sweet, angelic, wonderful voice, just came out and said that June is a hard deadline for the debt ceiling and that the odds that the U.S. will be able to make any payments on June 15th are quite low unless we increase the debt ceiling. Also, House Speaker McCarthy said that it's possible to get a deal sometime later this week. The president met with House Speaker McCarthy, but nothing really came out about any breakthroughs in that discussion. Minneapolis Fed President Kashkari, who's an FOMC voter, said that a decision to pause in June is a close call. And if the Fed pauses, it does not mean that the tightening cycle is over. The market could have taken this either way and gone up on this news because, whoa, what? Pause? But at the same time, oh no, interest rates might be raised in the future. It could have tanked. Instead, it pretty much didn't do anything. Then St. Louis Fed President Bullard, who's not a voter now, said that he thinks 2 more rate hikes are needed this year. Again, the market could have gone up on that. Wait, only 2 more? Poof, off we go. Or, oh no, there's going to be 2 more. Let's tank. No, the market really didn't react to that. The 4,100 level, if we start falling, is offering significant support, but we're having a real hard time with this 4,200 level providing overhead resistance. On a short-term basis, we have the CCI 1420, the Stochh RSI, the Williams Percent R. A new addition to the list is the CMB Composite Index. Those are all extreme positive. On one side, you can say, okay, we're hitting exhaustion. On the other side, you can say, wow, the momentum is shifting and it's more positive. Maybe that's a good thing. Intermediate term, we still have the Sean trend meter, which is extreme positive. The dollar was unchanged on the day and interest rates were up. Bonds are starting to see some weakness now, and I'll show you those charts. The 10 to the 5 is back on the list now as being inverted. The other ones, the 10 to the 2-year and the 10 to the 3-month, also are inverted. Sentiment is still positive. It came in at 70. It ticked up 1 notch from 69. Our trend is positive, but with the down day, the green line is coming down, so it is weakening, but the green line is still on top. The ADX is getting stronger. It's still above its moving average, but both are below 20. I've changed our bias to mixed and our momentum to positive. Until we really break through this resistance, it's going to be really difficult to have a lot of confidence in any upward movement. The economic reports that came out, we did not have any. Looking at some Isabel Net blog charts, here is just showing Goldman Sachs with their earnings per share estimates. They are the gray line here, and they're pretty optimistic about earnings going up overall, but they think that the S&P is going to go down. Looking at inflation, right now it's trending at 0.3% on a month-over-month basis. What does that look like on an annual basis? That would be 4.7%. That's the yellow line. That's if we keep sticking around where we're at right now. And then there's these other levels that work out to an annualized rate. This shows that equity flows have flattened just like in 07, which was a good year right before a bad year. 2015, good year before a bad year. 2018, good year before a bad year. This is just kind of a warning sign right now. Most folks still are in the stock market overall. That's why it's very important. Right now it's at 41%. About 17% own debt, that means bonds, and about 16% is right now in cash. Then looking at continuing claims, and this is what I've been trying to watch on the Friday video. We're watching this really start to go up right now. Folks get laid off of their job. That's the initial claim. But then if they stay on unemployment for an extended period of time, that's where they get picked up in this survey, and we're really keeping an eye on that. Also looking at the CAPE ratio, I deal with this in the weekly video. It just shows that we are still overvalued overall. And then looking at day 100 and then what happens when we're above 8% on the S&P going forward. We don't know what's going to happen for the rest of the year, but historically that has led to some pretty good things. Game of Trades had an interesting post that they actually got from sentimenttrader.com, which is a phenomenal website. But this just says the bear market probability model. It's the highest level ever. Are we going to hit this upper band and then start to go back down? Edward Yardeni chimed in also. We know that a lot of the strength in the market right now is coming from a small group of stocks. He calls them the Mega Cap 8. And the total here on the market cap is the blue line on the top. Then if you take out those 8, what the market cap is, and then how the Mega Cap 8, which is kind of like its own little made-up index, then looking at the 10-year Treasury yield and comparing it with the copper-gold ratio. A lot of times I deal with this over the weekend. It says right here, 2 of our favorite technical indicators for the 10-year Treasury bond yield are currently bullish. The yield tends to be highly correlated with the ratio of the nearby futures price of copper to gold. That's why we look at that chart. The ratio suggests that the yield, which is currently at 3.7%, should be much closer to 2%. We view the ratio as a risk-on versus risk-off indicator. Also, he looks at the economic surprise index. It's highly correlated with the 13-week change in the 10-year yield chart. It fell from a recent peak of 61.3 in March down to 5.5 in May. Notwithstanding these bond yield relationships, the yield has risen from a recent low of 3.31% in early April to 3.71% in today's session. Over the same period, the 2-year Treasury yield has gone from 3.83% up to 4.33%. This is being attributed to strong employment numbers, and also a few Fed officials have come out and said that they should continue to raise rates for right now or follow any pause in the rate hiking with further rate hikes if necessary. Mostly I wanted to go with what he said in his post. The chart is kind of hard to see right now. Looking at decision point, I haven't brought this up before, but this is a big influence in my own technical analysis training. I discovered decisionpoint.com well over 20 years ago. It's a gentleman named Carl Swenlin. That's the Swenlin trading oscillator that we use. And a lot of the studies that I use are originated from him. Well, his daughter has come in and also started to take over. This is a post from Carl Swenlin himself that he made over the weekend. He sees real weakness right now. He thinks that this is a sucker rally that we're going in because he sees a silver cross happening. That's when the 20-period moving average goes below the 50-period moving average. And even though we're going up in price, we're seeing a negative divergence on this chart. Recession watch. I also posted these in the groups as well as on Twitter. Are we going into a recession right now? Well, there's an outfit called the NBER, and they're the official proclaimer of whether we're in a recession or not. And these are some of the things that they look at. I'm hoping to do another supplemental video where I talk about, yes, it does look like we're going into a recession versus no, we're not necessarily going to go into a recession. One of the things that the NBER looks at are all employees, the total non-farm payrolls. And you can see this is really going up. If we were running into a recession, this should be going down. But this also goes hand in hand with other things that we've been looking at. The employment level also continues to hold up. The real personal consumption expenditures is dropping off a bit, but it's not falling off a cliff. And industrial production also is pretty much going sideways, but not really falling down right now. These are things that you can take and say, maybe we're not going to head into a recession. A lot of the other charts that I show you suggest that, yes, we are going to go into a recession. Now, looking at our own analysis, here's the intraday chart. We did have a higher open. We almost got up to R1 before falling down below the daily pivot. We never made it down to S1, and then we just chopped along this pivot level. Tried to go a little higher later in the day. That wasn't happening. And then we saw some late day selling and took us almost back down to the unchanged level. Here's the intraday chart where we were fairly positive in the overnight session when the futures opened on Sunday afternoon or evening. Not really telling us all that much. Here's the daily action, and we're actually quite positive now in the initial overnight session. Growth still continues to outperform value even though they both dropped. And then the growth to value ratio is also showing a little bit of weakness right now in Monday's session. Growth was down more than value, but they were almost unchanged. For the mid caps, growth underperformed, but for the small caps, growth actually outperformed. Looking at sentiment, our Ulcer Index continues to drop, suggesting there's just no fear right now. The VIX actually ticked up with the choppy to down action near the end of the day, both on the line chart as well as on the bar chart. The VIX of the VIX is picking up a little bit in its volatility overall. And then the MOVE index, it's not really moving up all that much. It is going up a little bit as bond prices are going down. The VIX still remains very low. The green line is the VIX minus the MOVE index, just to give us an idea of the spread between the two. And then the red line is the S&P 500. Then on the bottom, it shows they have a real strong tendency to go in the same direction. The skew index is pretty much neutral right now. This fear gauge did drop off a little bit. and the other fear gauge also declined in Monday's session. We're seeing a little bit of a change here, going from risk off more over to risk on. This line is really starting to come up and outperform. If this continues, we might be more in a risk on environment. Advanced decline line, we were up a little bit based on price. We're still showing a short-term negative divergence based on volume. It's below its moving average. We also have a longer-term negative divergence. The advanced decline ratio, we're just a little bit above the zero line. The new highs, even though they're improving and the red line is going up and the 10-year is going up, they're still lagging behind overall. Unless we really see a breakout, the new highs are not really going to expand. But accumulation distribution remains positive even though it declined. And then we're seeing other negative divergences here with the cumulative advanced decline line on the NYSE. We're also seeing the advanced decline line itself giving a negative divergence when comparing it to the price action of the S&P. But the NYSE advanced decline line is maintaining this upward sloping trend line. It hasn't fallen down below that, at least yet. Looking at common stocks, we also have another negative divergence. And then looking at our broad market, the NYSE advanced decline line just a little bit above the moving average for the NYSE. Pretty much sideways for the S&P, a little bit of improvement with the mid caps, but the small caps remain below a declining moving average. Looking at our trend, we are going back up with the ADX and above the moving average. So the trend is getting a little bit stronger, but they're both below 20. The green line is on top, but now it is declining. Volume continues to be below average. In the short term, here's the daily chart where we came right up to this resistance level and have not been able to break through that yet. On the bottom, you can see where volume is back to below average. The Stochk RSI remains extreme positive, as does the Williams %R. The CCI 14 and the CCI 20 are also extreme positive. We're still well above the 20-period simple and exponential moving averages, so the short-term trend is still positive. Our short-term stochastics still extreme positive but coming down. Intermediate-term extreme positive and still going up, and we're seeing some improvement with our longer-term stochastics. The force index, even though it declined, is still above zero. Here's the composite index. We're getting up near this black line here, which could be suggesting an extreme positive movement. Intermediate term, the balance of power is still below the dashed line, but it is showing some improvement. The double and triple exponential moving averages, price is still above both. The go-no-go system remains positive with darker blue bars. The TTM squeeze is also showing some improvement. The Arun is also positive, even though it was flat from Friday to Monday. The PPO studies, long-term, intermediate term, still positive. We're still above zero, but declining in the short term. The McClellan oscillator, we're just barely below zero with the S&P 500. The NYSE has actually crossed back above zero. The summation index, we're still headed lower based on price, but we're turning up based on volume, so we're seeing a little bit of discrepancy in this chart. But please keep in mind, the top part of this chart and the bottom part of this chart are calculated completely different ways. This is one that I actually posted in the Facebook group and on the YouTube channel and Twitter. This is just showing another negative divergence where we have the S&P on top where it's coming back up to previous price, but the NYSE summation index is not coming up higher, either based on price or based on volume. The PMO study, we're crossing over positive with the PMO, we're turning up based on price, and we have switched over positive based on volume. Our PMO study, still seeing this longer-term negative divergence with the percent on PMOs that are rising. We were pretty much flat overall. We've started to go back up with the buy signals, and we actually ticked down slightly with the PMOs that are above zero. The parabolic SAR system remains positive with the dots underneath. The Elder Impulse system remains positive. The Swenlin trading oscillator, we're above zero but going sideways, where we are seeing more improvement based on volume. The slope oscillator has now gone back to positive, and the MACD has also switched positive. So when we look at all of our oscillators, here's the slope, the TSI, the MACD, the PMO, and the PPO. Those have gone back to being positive. We're almost crossing with the TRIX and the KST. Those are our longer-term oscillators. We're still above all the plotted moving averages in our moving average tree. Here's the Sean trend meter, which continues to be extreme positive. And we're also seeing this negative divergence with the BPI. We came right down to 50. Above 50 is positive, below 50 is negative. We saw it tick up when we had that positive open. So this is showing some improvement, but we want to really get some strength out of this. And the NYSE bullish percent index did change a little bit, but it's still below 50 overall. So that's more negative. The Chaikin money flow dropped off a bit, but it's still above zero. The Chaikin oscillator also ticked down, but is above zero. The money flow index is right at 50 right now. Can you get any more in between? The vortex saw the green line going up. That's positive. The ultimate oscillator ticked down, but is also above 50. That's still positive. On balance volume, we're just barely crossing above this moving average. Then looking at some other negative divergences in the S&P, the stocks that are above their 200-day moving average, they're not really going higher right now. And the same thing can be said with those stocks that are above their 50-period moving average. The Kopit curve has generated a recent buy signal. Looking at the Fibonacci and line studies, we're still above this 4170 level. If we start to fall, that may provide some short-term support. Longer term with our Fib retracements, we're above this 50% retracement level. If we start to fall, we'll be looking at 4156 as another level of support. Then longer term, if we really start to fall, we'll be continuing to look at 4020. This is another area that we've been keeping an eye on, where we're coming right up to this resistance. This chart was inspired by a chart that Game of Trades posted. I think I called them Game of Thrones the other day. But I just drew a parallel line from the two lows that were set in October, and then an exact parallel line going from the all-time high down, and now we're bumping right into this spot. Is that going to provide some significant overhead resistance? And then we're at the end of that 50-day cycle, so we're starting a new one. Is that going to change the cycle? We've been sideways to more positive. Is that going to turn things more down or negative? And then this blue line here still suggests that there's a lot of E-mini contracts based on the Commitment of Traders report right at about this level, that if we start to go down below that, they're going to have to sell, and that could put a lot of pressure on the market. Our different charts, the Heiken Ashi remains positive, the Kegi is still positive, the Renko is positive, the three-line break is positive. Nothing new on the point and figure chart. We did have a double top breakout that was generated last Thursday. Looking at different indexes, the equal weight S&P 500 continues to underperform the S&P 500 itself. And then our new take on Dow theory, we're still above this breakout right here, but we're hitting overhead resistance at 4,200 with the S&P. But the NASDAQ continues to really break out. What's going to happen here? Is the NASDAQ going to pull the S&P higher if it keeps going up? Or is the S&P going to drag the NASDAQ down because it's exhausted and this is hitting resistance and everything shifts for a while? Also, the transports continue to underperform the Dow itself. The Dow came down to its 50-period moving average. The elder impulse system has switched to negative for the Dow. The NASDAQ, again, breaking out a little bit here and breaking above this 38.2% retracement level. If we fall, we'll be looking to see if that provides support. But then we're seeing a real negative divergence inside the NASDAQ, where the S&P has been going up, but the cumulative new highs minus the new lows continue to really show weakness. The NASDAQ 100 also had a pretty good day and is still breaking out. The elder impulse system for the Qs is positive, and we're above this 50% retracement level. If we start to fall, we'll be looking at the 13,614 level. And on a longer term weekly chart, we're still above this anchored moving average going back to the all-time high. This is a chart that's a few days old now. This is based on work from Tom DeMark, where we have a 9-13-9 combination. What that really means is that the NASDAQ 100 may be getting tired. Also, we're looking at the bullish percent index of the NASDAQ 100. This is another thing that kind of makes me think the NASDAQ might have a little more strength in it. If it can go above this line and then start to turn back down, that could signal that the NASDAQ 100 is exhausted and it could start pulling the S&P 500 down with it, if that scenario plays out. Also, we're seeing a real negative divergence between the S&P 100, which is really going up better, and the S&P 500. The S&P 100 are the biggest stocks in the S&P 500, It would be nice if these were both going in the same direction at the same time, but they're not. The small caps have bounced back above this pivot level, but are still negative overall. With the Russell 2000 small cap index, we're above 50 with the RSI, and the MACD has turned back positive. The small caps, though, even though they're improving, are really underperforming the large caps. And the small caps remain positive for the Elders Impulse system. And then we're looking at small cap growth versus small cap value. Even though the index is going down, look at what growth has been doing, especially since the beginning of 2023. This suggests that there's internal strength in the small caps. Now, looking at the mid caps, we're right in between the 50 and 200-day moving average and still below this pivot level. The mid caps remain positive for the Elder Impulse system. But look here, growth has really been doing well when compared to value, even though the index itself has been underperforming. The micro caps are still above 100 and advancing, so we just want to keep an eye on them. And then Dow 30, we're also seeing some negative divergence here, where we came back closer to previous highs with the Dow. We're seeing a negative divergence longer term with the transports. We didn't really see a divergence with the utilities, but lately they've been showing a lot of short-term negative divergence. The home builders, with the S&P down slightly, the home builders ETF was also down, the ratio went down, and their relationship is also starting to decline a bit. Keeping an eye on the financial sector, still in a negative trend overall, even though they were up slightly. The financials continue to underperform the S&P, and the regional banking ETF continues to underperform the financial sector, even though they're bouncing back up a bit. Looking at our interest rate studies, there are a few changes in this chart. The 1 to 3 year, which is shorter term, and then comparing it with the 3 to 7 year, which is longer term. If we were going down, that would suggest that maybe the Fed is done raising interest rates. Well, based on this debt ceiling issue and what's been said coming out of the Fed, this ratio is starting to go back up into the rainbow. And then looking at longer term versus shorter term, if we were feeling more confident, this ratio would be going back up. That's not what it's doing. It's starting to go back down. But then looking at the S&P compared to bonds, and this is the base of what I did that supplemental video on, we're still going higher overall, suggesting that there could be a soft landing scenario that plays out for the economy. Growth still continues to outperform value. Looking at bonds, we were up based on yield, down based on price. This is a little bit of a concern. When you look at the S&P and then compare them with long-term bonds, they have a long-term relationship of going in the same general direction. This is really starting to fall, meaning they're starting to go in opposite directions. In the shorter term, they're also going in opposite directions, and the spread between the two is still quite wide. Then looking at 1 to 3 month bills, which is cash, and then comparing it with further out bonds. When this is going down, that means the market is more confident. When this starts to go back up, that means that there's a lot of uncertainty concerning interest rates. We had been seeing this really going down, enough to give us a death cross with this ratio, but over the last few days, it's really been spiking back up. Our long-term analysis, we're still not above this red line with the special K. And this is a new one, and I'm not sure I'm going to pronounce this right. Zahorchak? All right, what a name to have. This is a longer-term indicator that we use that when we're down here, that's, of course, negative. And then when we pop up to the top, that signals something positive. And this doesn't generate an awful lot of signals. There was one back in 08 and 09. Those were bad times for the market. 2016, we ran into some trouble. 2019, into trouble. The COVID plunge was so fast and furious, it never really got a chance to come down here. But 2022 and 23 were still giving negative indications. Well, now this has really shot up, and that could be longer-term positive for the market. Our long-term analysis on our weekly chart, the MACD continues to be above its moving average, suggesting that this breakout above the trend line is legitimate, at least for now. An update of some possible positive scenario charts. Longer term, comparing growth to value, we're still holding up fairly well. The Qs outperformed the S&P, where discretionary turned down compared to the S&P, but large cap growth continues to outperform large cap value. Our other growth value ratios, large caps doing well, mid caps doing well, small caps not so much. This is also showing some improvement. The S&P ratio to the utilities is starting to spike up. We'll keep an eye on that. When this really starts to get strong, that can often signal some pretty good strength in the S&P itself. Broader range, we're still negative overall when we look at the new highs minus the new lows and take a 5-period moving average. We're still barely positive here with our 19-day exponential moving average of the advanced decline ratio. We're just barely above zero based on price and volume. Then looking at our new highs, new lows longer term, we're still above this zero line and turning back up. We look at the black line, which is the indicator itself. On the previous chart, it's the red line is the only one that I have plotted there, and this is still giving us a positive reading overall. The 2-year Treasury yield, it looked like we were spiking and coming down. Well, now the 2-year Treasury is starting to go back up. This is also potentially positive. You see how the staples to S&P 500 ratio is really declining? That could give some really good support to the S&P as it has done in the past. Is that going to happen this time? So what's our outlook for Tuesday? We're still dealing with earnings season. The technicals are positive overall in the short term. We're breaking out, but we're at this 4,200 level, which is resistance, and we may be getting exhausted not only in the S&P, but also in the NASDAQ 100 and the NASDAQ. Economic reports coming out on Tuesday. We've had 2 days in a row without any reports. That's kind of strange. We have the IHS market manufacturing. That's one report. And then the services PMIs. That's another report will also be coming out. They're not really big, influential reports. New home sales, that could be influential. It'll be coming out. Then the whole list of geopolitical events. Right now, it's pretty much the whole debt ceiling issue. Longer term, we have inflation and interest rates, and then any more banking information. The Stock Traders Almanac statistics. We're now into the week after expiration where we've been up 64% of the time and down 36% of the time. For May 23rd, we're neutral to positive with the Dow and the S&P as well as with the NASDAQ. We do tend to be positive overall in the month of May. However, we tend to see some weakness about this time. We are currently on the 17th trading day of the month where the green dash line is showing a little bit of a decline. This is what I'm talking about, where we look at the month of May, both for the green line, which is a pre-election year after a midterm bear. That's what we have right now, as well as all pre-election years. No matter what you look at, we do see some weakness in May. The Stock Traders Almanac, in their research, has found that the weakest of the weak months tends to be May overall. However, the blue line here in a pre-election year does suggest that we are positive, but still underperform other months in the year. Then this goes back to the 2011 debt crisis and just annotates this with different events that have happened. The blue line here is about where the S&P is at. The black line is what the S&P did in the past. Also, Shivako Capital put out pretty much that same chart. We're right about in here right now. We see some weakness, then we bounce back up, and then later in the year we might see even further weakness. Our scenarios, hard to go with the down one right now. It's hard to go with any scenario. The technicals are still positive with negative divergences, and we have a really weak trend. That also applies to the uptrend as well. So we still default to the sideways or neutral trend because the ADX is strengthening. It's above its moving average, but both of them are still below 20. The green line's on top, but it is declining. Then Fed speak that we're going to get this week. There's only one speech, and that'll be on Wednesday at 2:10 p.m. Warning signs, things to be aware of. There are still numerous negative divergences that are all coming together. The VIX is still showing a lot of complacency. The S&P new highs, they are improving, but they're still lagging behind, and they probably will continue to lag behind unless we can break out above 4,200. The NASDAQ cumulative new highs, new lows are showing weakness, although the market has been going up. The S&P is underperforming utilities, but this could be improving. The risk-off posturing continues, but it may be changing. We might be shifting more to a risk-on posture. The small cap index is underperforming, and the mid cap is also underperforming and recently generated a death cross. The NASDAQ and NASDAQ 100, are they getting exhausted right now? You can make a play for that, but we keep going up. They're just going to get more exhausted. Earnings season continues. This could be positive or negative, but we're kind of getting near the end of that. On the positive side, the Copic curve is generating a buy signal. Longer term seasonality and setups, those apply to the whole year. They're still in the background. Lower price levels may provide support. We're still looking at 4,100, 4,080, 4,020 as possible support levels. If we fall, the NASDAQ is breaking above resistance. Small and mid-cap growth is continuing to show strength overall. Is the market bottoming after it had gone sideways? That's one of the things that we've been thinking about. Will a resolution to the debt ceiling produce some kind of short-term rally, or is it going to produce some kind of sell the news type of thing? So our conclusion, the S&P, it's positive still, even with the slight up day. It's not trending. It's showing a lot of negative divergences right now. Is it breaking out, or is it exhausted? Is it hitting overhead resistance? In the short and intermediate term, we still remain positive, as well as in the long term. So thank you. I really hope you found this useful. I hope you have a really good day, and I will talk to you in the next video.